Welcome to the latest Motley Fool scoreboard. I'm Anand Chokkavelu, and we've got longtime fools, Matt Frankel and Jason Hall, giving a 1 to 10 rating to the REIT that specializes in lower-end housing options. It's Sun Communities, ticker symbol SUI. Talk about the business first, including factors like industry and competition. A 10 is invincible. A 1 is hopeless. Matt's at a 7. Jason, you're half a point higher at 7.5.
Yeah, I'm half a point higher because they're in the process of closing on the sale of Safe Harbor, which was just that it was their harbors business for lake harbors, and it makes it a lot more appealing, less seasonal and cyclical. It's going to let them clean up the balance sheet and really focus on the manufactured homes community and also their RV parks community businesses, which I just think are going to be better businesses.
Yeah, depending on who you ask right now, there's a shortage of about between 3 and 6 million affordable houses or affordable homes for Americans, depending on what source you're looking at. And Sun Communities, I can't think of a better affordable housing play than manufactured housing and permanent resident RV communities. It's an affordable housing play. It's got a great portfolio of assets. I think they're making the right move getting out of the marina business. Although the marina business can be great, but not for them. I like a lot of what they're doing, but we'll get into that in the next section. But generally, it's a play on affordable housing, but it's not without its drawbacks, which is why I only gave it a 7.
Safe Harbor sounds like a place lawyers stash their boats in the Caymans. Let's talk about management. A 10 is Warren Buffett. A 1 is Homer Simpson. Matt's at a 7. Jason's at an 8.
Yeah, so this one was the one that I really struggled with the most. And the reason I went with an 8 is so Gary Schiffman and his father founded the business years and years ago. So Gary Schiffman is the current CEO. And maybe I'm going a little bit high here because the business hasn't done great as an investment over the past few years. It's underperformed the market. But largely because they bought Safe Harbor in 2020, and that proved not to be a good decision, but they're correcting that. And that course correction, I think, is really valuable. Maybe Schiffman retiring at the end of the year, there's reason for concern. But you look at the long-term history of this business under current management, past 3 decades have gone pretty incredible.
Yeah, they made a mistake in the 2020 era that a lot of companies made, in that they tried to do too much. There were a lot of businesses that tried to put their hands in everything, because when you think about what was going on in 2020, 2021,
money was free.
You had to be an idiot to not make money in business. Everybody who had a stock portfolio looked like a genius at that point. It was a different environment. They're course correcting. They're doing 3 things that I think are going to get the business back on track. You mentioned they're divesting Safe Harbor. They're disposing other non-core assets to help deleverage the balance sheet. They got rid of $570 million in non-core assets just last year alone. And they're in the process of actively converting a lot of what they call their transient RV sites, like where you or I might rent this space in a campground, converting them to annual lease spaces, which is more cash flow visibility and generally a better return. So they're doing those 3 moves, and I think that's smart management.
Yeah, well, those annual sites, here's the thing about it. You don't generally just get an annual tenant. You get a long-term tenant.
Right. So it's it's turning an RV site, which has a great cost of ownership, into an apartment, essentially.
For financials, a 10 is a fortress. A 1 is yikes. Both of you have 8s, Jason.
Yeah, so the Safe Harbor sale is going to do a couple things. It's going to help delever the balance sheet. It's going to give them some additional capital left over for other things. And the balance sheet's never been an issue for the business, even though it's moved higher. But again, they're about to address that. Again, this sort of business is built to generate pretty consistent cash flow. And I think we're going to see that even tighten up with the moves that they're making. They don't have a lot of vacant properties. The occupancy rates tend to stay really, really high. And for a REIT, that's the number one thing to having a good balance sheet tied into managing your debt load. And I think they're doing those things well.
Yeah, I agree. I don't have too much to add. The debt to EBITDA is a little on the high end for a REIT, but not to the level where it's very concerning. Should gradually improve over the next year or so. And rental rate increases are strong. The portfolio is very highly occupied. I think it's 99% same store occupancy at their mobile home parks and RV resorts. Great occupancy, great rental rate increases. It's just the debt and the Safe Harbor mistake is a drag right now.
Matt, let's move on to valuation. How well will Sun Community stock do over the next 5 years, and how safe is it? 10's a sure thing, 1's a lottery ticket.
I said 5 to 10%, which is actually lower than their historical performance, as Jason alluded to earlier. Over the long run, I believe they've beaten the S&P pretty handily when you really zoom out. I gave it a 7 safety score. Any company that's in a turnaround, which is really what I would classify this as, they're in turnaround right now. It's tough for me to give above a 7 to any business that has. It just adds a big element of uncertainty, which is, if they can execute, if they can successfully deleverage the balance sheet, convert their RV sites to annuals, and just kind of get back to where they were and the historic business model, they could definitely be above 10%. But I say my base case, it's probably on the higher end of that 5 to 10% range.
Yeah, directionally, Matt and I are in the same boat. The reason I rate it a safety score of 8 is I think it's less of a turnaround and more of an optimization. The biggest turnaround is getting out of the marinas business, like you said. With the RV communities business, they're actually moving up scale because a lot of those annual lease, those are vacation homes for their tenants, which tend to be retirees, people that are a little further up the economic strata. So I think those moves, even as they're focusing on the other end of the barbell with the manufactured homes communities, creates a safer business, I think. However, I'm not convinced that it's going to be on the higher end of that 5 to 10% returns. Dividend yields around 2%, so that you don't have that higher floor with the dividend that you get with like the realty incomes of the world with the higher yield. So you are still counting on heavier lifting by management to grow the value of the business. I think the valuation is reasonable. It's not super cheap. If it was super cheap, I'd say maybe a higher returns, but I think somewhere in the mid-range of that 5 to 10% is probably the most likely case going forward.
Do either of you worry about recessions with this, space in particular?
If you asked me that 6 months ago, I would have said yes, very much. But based on the things that they're doing to change the business, I don't think that's the case.
Yeah, the shift to annual leases in the RV space does wonders to help with recession fears. Transient RV, people travel less when recessions are going on. So I think they're taking the appropriate steps to insulate themselves from recessions.
Right on. And selling off Safe Harbor helps
Right.
with that balance sheet problem as well.
Yeah, marinas are very recession prone.
Oh, fair enough. So double duty there. Matt, is there a company in Sun Community space that you like better for a top it?
I mean, I would argue that there aren't many other REITs in Sun Community space, just because they have a kind of unique mix of assets. But if we're just looking at residential in general, I slightly prefer Avalon Bay Communities. They're just big, they're well capitalized, they have a great cost of capital, and they are starting to focus on things outside of the expensive urban markets that they've historically done, like some Florida markets that are more affordable. So I like where they're going.
Yeah, I'm going to move to the other end of the spectrum, but still kind of stay in that residential specialized and talk about Invitation Homes. So it's a residential REIT, but it focuses on standalone single family homes for renters. There's a lot of demand for people to live in houses. Inventory is more constrained, and there's a lot of people that don't want to own for various reasons. So this is the leader in that space, and I think it's a space that the tailwinds are going to allow it to continue to grow.
Thank you to both Jason and to Matt. They've given Sun Communities a solid overall score of 7.1 out of 10. Middling returns expectations lowered the score a bit, but the fundamentals and the safety all averaged in the 7 to 8 range. Look out for a new scoreboard every market day at 7 p.m. Eastern. Next up is something good, I'm sure. Till then, Fool on. Let's talk about top
Absolutely.
Sorry, Jason.
No, that's it. I'm just agreeing.
All right. Definitely don't want to cut that off.